Welcome to the daily update, where I'll go over the action in the market for Friday, August 9th. Then we'll see how things look for Monday, August 12th. We had another up day, up about 0.5%. Given what happened on Monday, the market's held up pretty well. We had that big decline, and we've been chopping back. We're still negative in the short and intermediate term, but we're pretty much not oversold now. We are showing some signs of improvement. Some of our indicators are looking a little bit better, but when you take it all together, we're still negative in the short and intermediate term, but we're still negative in the long term. I do have a thing called the SPXInvesting Program. It's still free. All it requires is an email address. Feel free to check that out. At some point, I will be locking that down in August. If you want to find out more about it, you can email me here with the email address, or you can click some different links to learn more about the program or actually take you to the website. Also, this video that you're watching now, the daily video, this is the real foundation of the analysis and commentary that I do. Now that it's the weekend, I will be preparing all the outside videos except for the supplemental video. Those are as needed. But these videos are designed in such a way so that everything feeds into the daily video. All right, let's go back and talk about what happened. We had pretty much a flat open, nothing really all that great to the upside or downside, and we stayed near the unchanged level after the open. And then we were able to climb our way up to R1 at 53.54. Then we fell back to close below R1. So it was a pretty slow day. We were up 0.47% on below average volume. And we are still negative in the short and intermediate term, but showing some signs of improvement. This coming week, we should get some more insight as to what's happening. We're going to get PPI, CPI, and retail sales throughout the week. And then all the different geopolitical things that could have an impact on the market if they escalate. Some comments. We did have another good day with mega caps, growth stocks, and semiconductors. So that's really what helped the market indexes anyway move a little bit higher and show some improvement. And we have just the slope oscillator now. Our momentum is still negative too, with the slope oscillator being our short-term touchiest oscillator. It's still looking extreme negative. And we still have the TTM squeeze showing some improvement, but still looking extreme. The ease of movement and the Chaikin money flow. Both of these are also improving, but still looking extreme negative. And the market is pretty much counting on the Fed cutting rates in September. We'll have to see if that ends up happening. If it ends up not happening, that could really rattle the markets pretty heavily, but we still have some time until that's getting closer to actually happening. And the dollar was down, interest rates were down. We did come back down under 4%. We closed at 3.94% with the 10-year yield, where we had been back up to 4%. We're still inverted with the yield curves. We came close a little bit with the 10 to the 2-year, but it hasn't quite gone back to being normal yet. We're still extreme negative with sentiment. We didn't see that change. It came in yesterday at 24. It's still at 24. It's below that 25 level. And this is when we look at entertaining the idea of using it as a contrarian indicator. And we are still negative with our trend, even though the red line is coming down. The ADX is rolling over a bit, but it's still above its moving average. With the update, we are positive, so the bias is positive. And I've changed our momentum back to mixed. We haven't really fallen apart yet. We'll have to see if something comes up in the next week or so with all the economic reports coming out, to see if that ends up changing, either more negative or switches back to looking more positive. Didn't have any economic reports on Friday, so there's no charts to show you. Here's a historical chart, just looking at what the Fed has done and then what the 10-year rates were during different times. I won't go through all of this. This is more of a history lesson type of a thing. And then what was the S&P doing at that particular time? And then the longer the holding period, the more likely to see gains. And yeah, I mean, this is kind of common sense, I guess, in a way. But if you have time on your side and you can hold something for a long period of time, the market tends to go up 70% of the time long term, and it goes down about 30% of the time, with that 70% winning out over the long haul. My approach to this is I kind of blow this out of the water a bit, where I do use this approach with my long-term portfolio, but then I implement hedging when we run into difficult times. But then I use the short and intermediate term to play either the upside or the downside and implement different strategies so that you can actually have some pretty solid gains no matter what the market is actually doing. And then here, the S&P sell-off has been sharper than the average correction over the last 100 years. This is when we peaked out, and this is how things have been developing ever since then. But we are showing some improvement now since we saw that big down day on Monday. And then the probability of a recession, and I don't know how they do this. Somebody sits at a spreadsheet or something and crunches a bunch of numbers to come up with, okay, 25 or 26% for the S&P 500 thinks we might go into a recession. And then across the board, and we have the 5-year and base metals are actually more looking at a more probable bout at a recession here. But I'm not sure the logic behind all of this, but the market is constantly playing this game. Are we going to go into a recession? Are we not? And they try to front run these things, and we get statistics that look like this. We're seeing a big outflow of junk bond funds right now, and we've been seeing that in the intermarket analysis video over the weekend. I'll go over this again. But the light blue line here just shows money's been coming out of junk bonds. And then we looked at a chart a day or two ago that shows money is going back into the more conservative bonds because folks think that, all right, now I'm not willing to take on that risk to get the more enhanced yield with a junk bond. I'd rather stick it over into a more conservative bond because maybe interest rates have topped out and will start to come down, and I've already locked in a higher interest rate. Then cash flows, it's down at 11% here. It's below average right now as folks still, they're taking some money out of the market right now. And then we're seeing outflows from banks, and I'll also go over this in the intermarket analysis video, where we're seeing some money coming out of banks recently. And then the equity markets size reflects the dominance of the U.S. economy. No real surprise here. The U.S. has the biggest stock market and also the biggest economy. I didn't see anything from Yardeni. This is the weekend, so he probably won't post anything until Sunday or Monday morning. And just one chart to show you here. And this is another thing that I've been talking about, is it if the Fed is cutting interest rates to try to stimulate the economy and we don't go into a recession, that's the dark blue line here. And we tend to do very well when that happens. And that's kind of what the market is hoping for. If the Fed comes in and cuts rates because there's economic weakness and then we do go into a recession, things tend to get pretty bad. And the debate is going back and forth. There's lots of opinions out there. We watch the charts. We're still kind of on the fence whether either the more positive scenario or the more negative scenario is actually going to play out. Okay, a real kind of a sleepy day in comparison, especially to earlier in the week where we had pretty much a flat open. It looked like we were going to go down a little bit, but we just kind of trailed along the unchanged level for most of the opening part of the day. We were able to get up to R1, but that was the high that we set, and then we drifted down underneath R1 for the rest of the day. And nothing really all that big here. It was pretty quiet from Thursday to Friday. We're still seeing the red line on top, so value is still outperforming growth. I saw a little bit of improvement here when we look at S&P growth to value on a ratio basis intraday. And so growth was up where value was also up, but growth was up a lot more. For the mid caps, growth ended up being down. And for the small caps, growth was up, where for the value of small caps, it went down. And so looking at our ratios here on the end of day charts, not really showing an awful lot of strength with the small caps, a little bit of a bounce with the mid caps, and also a little bit more of a bounce with the S&P growth to value ratio. Not really seeing much of an improvement, but a little bounce here when we look at discretionary versus staples. Keeping an eye on these two different ETFs that we do a ratio here. We've come back up into the rainbow now. So this is showing a little bit of an improvement. Large cap growth is trying to get back above its 100-day moving average, so that's showing some improvement. And we're going back up here, meaning that the large caps are starting to outperform the small caps. And here's our trend. The ADX is weakening a little bit, but it's still above its moving average. The red line's still on top, so we default to positive, but the red line is also declining. Rolling over a little bit more with our short-term ADX chart here, but the red line continues to decline. And we dropped off below average with volume. So we saw a pretty solid up day. In fact, one of the better up days we've seen on Thursday, but average was below, or volume was below average. And then we saw below average on Friday. This is more of what we typically see during the summer months. Then here shows the ulcer index is still pretty high when we're looking at fear in the market. And we're still getting a high reading with the VIX, even though it's really coming down from those just astronomical figures that we were seeing back on Monday. So we're also dropping here with the VIX of the VIX as volatility is slowing down a bit. And this is the historical seasonal chart that we look at, where typically going into August, we do see a climb in the VIX. And so far, that's been what's happening in 2024. We're rolling over a bit here, but we still show that the momentum for the VIX continues to be up. And we're coming down, still getting pretty high readings here when we do a ratio between the VIX stocks and the MOVE index bonds with each other. And coming down here, when we look at the MOVE index, this is the volatility of bonds. The VIX is the volatility of stocks, but the correlation between the two is still quite high. And we saw a real drop-off with the equity put-call ratio. Now, we had that big up day on Thursday, and the equity put-call ratio really shot up. Well, folks were getting out of those put options here in Friday's session. So we're starting to turn back down with the 5-day and just rolling over a little bit here with the 10-day. And then we're keeping an eye on the spread between risky and not as risky bonds. It's coming down and showing a bit of improvement. And this is more of a blow up of that chart, where when this is going back up, that means the risk is coming down when we look at the spread between the two types of options and bonds between them. We declined with the fear gauge on this chart. We also declined with this other fear gauge. And we're ticking back up just a little bit, getting a little bit more friendly towards the risk on scenario. And the volatility risk premium is now dropping below the band. So things are starting to calm down here a little bit. So a little, not really much of a change, a little bit of an improvement here with the advanced decline line based on price. We're pretty much flat to a little bit better based on volume. And now we're dropping off with the 5-day and the 10-day, but we're holding up fairly well with the new highs, new lows, another internal measure that we look at. And we're looking positive here with the advanced decline ratio, both for the 19 and the 39-day above zero. And working off that extreme reading that we were seeing with the boom indicator here, as we're coming back up, we're still below a declining moving average with accumulation distribution, but it's looking a little better. Also starting to go back up a little bit here with the check and money flow, but the red line hasn't quite started to turn up at least yet. So negative, but showing improvement. And we're continuing to go up here with the chicken oscillator, but we're still below the midpoint. So it's negative, but improving. And we tick back up here with the NYSE cumulative advanced decline line. And we're also, and this is one encouraging thing for the broader market. Even with the down day on Monday, we never dropped below the moving average with this advanced decline line. And this other advanced decline line for the NYSE is also still looking fairly solid. And then we look at the NYSE common stock based on price, where we tick back up, and we're ticking back up a little bit better based on volume. The one thing that was concerning us is we were seeing volume going down with more velocity than we were price. And looking a little better here with the S&P advanced decline line based on price. It's ticking back up. We were also going down faster based on volume, but this is showing a little bit of an improvement. And the red line is still above the S&P here. And even though they're on different scales, this just shows that the broader market is holding up fairly well right now. And our advanced decline line still looking good with the NYSE common stock, the S&P, even though we were flat, still above the moving average with the mid caps, declined a little bit here with the small caps. And not really much to show here with the daily chart. We're still below the 50-day moving average. We were able to get above the 100-day moving average, but I'll show that here in just a moment. But we really dropped off with volume to well below average. We're no longer extreme, looking a little more positive here with the Stochc RSI since we crossed above the midpoint, just a little bit below the midpoint with the Williams percent R, no longer extreme with the CCI 14 or the CCI 20. So we pretty much have worked off that short-term oversold condition now. And we're not looking extreme here with the stochastics in the short term, intermediate term. We're trying to turn back up in the long term, but nothing is extreme negative. And this is the condition of the 20 period moving average here, showing a little bit of improvement. We're trying to get back above both of these lines. If we can keep going up, that would turn the lines back positive or looking better, but we're still below the 20 period simple and exponential moving averages. The force index is still negative, but showing some improvement. We're ticked up just a little bit with the 20. We went up with the 50, and we actually declined a little bit with the 200-day moving average study. And we're coming back up into the -1 channel here with the standard deviation. We're still negative, but we were quite a bit more negative and showing some improvement here. And the balance of power showing a little bit of improvement, but still negative. Here's the condition of the 50 period moving average, still below both lines. And as long as we stay below them, these lines will continue to decline. Here's the 50 period moving average, still below both of those also, but looking a little bit better. And we switch from being the dark purple or deep purple here to a more smoke on the water look here with the lighter shade of purple. And coming off of the lowest low value, but we're still below the midpoint here on this chart. The TTM squeeze showing a little bit of improvement, but still extreme negative with the lighter shade of red. And here's a longer term look at that same chart to give more perspective. We're coming down just a little bit, but standard deviation just shows, I mean, we've been darting all around as stocks, or at least the S&P has really been moving lately. And the ease of movement is showing some improvement, but still extreme negative. The Erin is just flat. It doesn't really think anything happened. And we're turning back slightly positive here with the S&P McClellan oscillator. We crossed back above zero. So we're starting to flatten out and actually turn up a little bit based on price, but we're still declining based on volume. We're still negative with the NYSE McClellan oscillator since we're below zero. So we continue to decline with the NYSE summation index based on price and volume. Seeing a bit of an improvement here with the Swenlin trading oscillator, but both based on price and volume, we are still negative. Momentum continues to be negative. When we break it out based on price, we're also negative, and we were negative for longer here based on volume. So a little bit of a tick up here with the PMOs that are rising. The buy signals are showing a little bit of an improvement, and we're flattening out with the PMOs that are above zero. Still negative with the parabolic SAR chart. We are still neutral with the Elder's Impulse system for the S&P. Rolling over a little bit here after getting really extreme with the slope oscillator, but still negative. The MACD trying to turn up a little bit, but also still negative. So all of our oscillators, especially in the short and intermediate term, they're trying to turn up here, but they haven't crossed back above their moving averages yet, where we're still negative with the long-term tricks and KST oscillators. Trying to turn up here with the Copic curve, but still negative. And we did get a little bit more distance above the 100 period moving average. This had been acting as overhead resistance, so the fact that we were able to close above that is somewhat positive. And this also just shows all the moving averages together. The longer we stay below these shorter term moving averages, the more they will continue to roll over. Saw a little bit of a tick up here with the Sean trend meter, but not getting any kind of an extreme reading. We're just a tick under 50 right now with the bullish percent index. So it's showing some improvement, but it's still negative. And also a little bit of a tick up, but below zero with the NYSE bullish percent index. Seeing a little bit more strength here, but negative with the NASDAQ 100 bullish percent index. The money flow is still below 50. That's negative. We're also below 50 with the ultimate oscillator, which is negative. The red line is still on top, but flattening out with the vortex. And we're trying to come back above the moving average here with on-balance volume. We're seeing some improvement with our 20 period moving average study of those stocks inside of the S&P, but we're still below 50. We're back above 50 with the 50 period moving average study, and actually ticked down a little bit with the 100 period moving average study and ticked down with the 200. And we're still waiting for the mass index to roll over to see what kind of a signal this ends up giving us. showing some improvement, but still negative with the RSI 14 as well as the RSI 9. And we're wondering, we didn't really get too close to this 38.2% retracement level, even though it looks like we kind of got close. We were still a good 100 points away from that for the S&P, but we'll be keeping an eye on this if we do start to see more weakness. This is also encouraging. We held this R1 level. This is a weekly chart of the S&P. Even though we dropped below R2, we were able to stay above this R1 level at 5111. And the fib extensions, not really showing any strength right now, but a little bit of improvement as we were able to get back above the 23.6% extension level. Coming back further into the cloud with the Ichimoku study here, still negative. The red line is still above the blue line. It would turn more positive if the blue line would cross back above. Also seeing a little bit of a tick up here with the green line. And since we're back in the cloud, that's showing a little bit more support. Looking a little better here with the Heikin Ashi with an open candle. And actually turning back positive with the Kegi chart. It's black and pointing up. But the Renko chart is negative and the 3-line break is still negative. And we saw enough of a bounce on Friday to put in another X. And now we have a signal, which is a low pole reversal. So we are seeing some improvement in our price charts, but not positive yet. We actually ticked down with the 150 and the 200 moving average study longer term. We're still negative in the short term with all the different indexes, but we're also negative in the intermediate term with the NASDAQ 100. And with commodities are negative across the board. The dollar is still negative when we look at the short and intermediate term trend. They finally made some changes here on the decision point scorecard. We're now negative. Going back to July 24th, you think that's a little out of date now? And then they changed it over to the midterm, or I call it intermediate term. Now, in my opinion, the PMO should be negative, but they didn't see it that way. And we saw lots of blue here. NASDAQ did see a little bit of weakness here, but most of this ended up being positive. Canada ended up having a pretty good day as well. And all of the sectors except for materials ended up being positive, with communication, that's one of the growth areas, looking about the best. And showing, well, we're still negative here. We're looking a little bit better, but we're still getting a reading of -7 when we look at the new highs minus the new lows on the NYSE. Looking okay here when we compare the equal weight, that's the red line, with the S&P. When it's above, again, they're on different scales, but when this is above, that means that the equal weight is holding up better than the S&P weighted index. And we saw a little bit of a tick up here with the mega caps doing a little bit better with this ratio. And we're just a tick or so above the 50-day moving average with the Dow, but we still remain neutral with the Elder's Impulse system. Seeing some improvement, but still below S1 here with the NASDAQ. And coming right up a little bit above this S1 pivot point and seeing some improvement with the NASDAQ 100, but we continue to be neutral with the Elder's Impulse system. And seeing some more improvement here with our fib extensions with the NASDAQ 100, but we had fallen down completely below. But you can look at the price action here with the candles where it is looking a little bit better, at least right now. NASDAQ 100 momentum trying to turn up, but is still negative and extreme negative. The Qs are still above their 200-day moving average. We are a bit concerned because the 20 has now crossed below the 50. The longer it stays below this, the more it will take for this to cross back over positive. Small caps ended up being down slightly and are just a little bit above their 50-day moving average. A little bit below their 50-day moving average here with the Russell 2000 small caps, tick down and below 50 with the RSI. The momentum for the small caps continues to be negative, and we continue to be neutral with the Elder's Impulse system for the small caps. Mid caps still below their 50-day moving average, still below this S1 pivot level, and continue to be neutral with the Elder's Impulse system. The Wilshire looking a little bit better, but below its 50-day, but above its 200-day moving averages. And also kind of in between the two here, when we look at the total U.S. stock ETF, came down a little bit here with our staples to tech ratio. If this declines, that means the tech sector is outperforming. If this is going up, that means staples are outperforming. This is growth versus defensive here. and coming back a little bit further above the 50-day moving average with the financial sector. So this is looking more positive. The FANG index, which had bounced off its 200-day moving average, it was up over 1%, but still below its 50-day moving average. Apple was up 1.33% and climbing back above its 50-day moving average, trying to get back up to the 200-day moving average with Amazon, at the 200-day moving average with Microsoft. Climbing and looking a little better is Meta, up 1.6%, and in between both moving averages with Google, but also was up over 1%. Tesla is still down below both moving averages after giving us a golden cross. Nvidia ended up being down 0.21% in between the 50 and 200-day moving averages. Netflix was up over 0.5%, but still below its 50-day moving average. And looking at the broad market here, we're still looking more negative, but this takes a little longer for this to update here. This is looking at the Amex, NASDAQ, and NYSE and taking a 5-period moving average of the highs minus the lows. We're still below zero. And we want to keep an eye on oil. This is more for geopolitical reasons in case things really start to escalate in the Middle East. The dollar is still in an uptrend, but it was down and that gave some support to stocks. And we're keeping an eye on the small cap to tech ratio. When this is going down, that means tech's outperforming. This started to really go up as everyone was falling in love with small caps. Well, this is now starting to come back down again. And looking at US versus international stocks, the short-term correlation is pretty strong, and we're seeing the longer-term correlation continue to strengthen. And we were down slightly here with the 10-year yield, actually back down below 4%, and we were up with the 10-year based on price. But we're not seeing any real strength here. We're seeing some improvement with our growth to value ratios, with the Qs to S&P turning up, but still below a declining moving average, still declining with the S&P, or discretionary to the S&P, turning up but below a declining moving average when we compare large cap growth to large cap value. So turning up but below the moving average with the large caps, mid caps, and small caps. And ticking back up, but still we've been declining overall with our S&P to utilities ratio. And starting to come back down, but we have been really going up with our staples to S&P ratio. So a little bit of improvement, but not anything necessarily positive right now. We were able to get back above the zero line here with the advanced decline ratio based on price, but we're still below zero based on volume. So what's our outlook for Monday? We're still negative, but showing signs of improvement. And we're not going to have any economic, hell, that's not right. We'll look at the next chart here. But we want to keep an eye on all the different geopolitical things, the things going on in England and in the UK. There's the closing ceremony for the Olympics. There's all the craziness in the US. There's the war between Russia and Ukraine. There's possible escalation in the Middle East. So there's lots to be at least focused on to see if it impacts the market. Yeah, we're going to get Treasury budget on Monday. And then this is going to be a big inflation week. We're going to get PPI on Tuesday, CPI on Wednesday, retail sales on Thursday, as well as industrial production and capacity utilization. And then Friday, we'll get consumer sentiment. And here's the upcoming economic calendar. Seasonally, we're negative with the Dow for August 12th, and we're neutral to negative with the S&P and NASDAQ. We are coming into options expiration for the monthly cycle. We have a little bit of an edge being slightly more positive than negative historically. Monday is the most positive day of the week based on what happened in 2023. And we see a little bit of negative seasonality here as we enter into the 8th trading day of the month. And this is what we're keeping an eye on since this is a very unique situation where the incumbent president does not run for re-election. We still end up doing fairly well. But we want to keep in the back of our mind, September on a seasonal basis tends to look quite negative based on this chart as well as this chart. But during an election year, August tends to do better than the other years that are measured in this chart. So we're still keeping an eye on these different defensive sectors, staples, utilities, and healthcare. Energy, specifically oil, is more of a variable right now because we don't know if that's going to be geopolitical or not. Growth to value and discretionary to staples, improving a little bit, but just not showing any real leadership or strength. This should actually be on the other slide. Both the 5-day and 10-day equity put call ratios are now back to going down. Accumulation distribution is showing some improvement, but still negative. The Chaikin money flow, again, extreme, but still negative. And the Chaikin oscillator is actually, it's still negative since it's below its midpoint, but it is advancing right now. The NYSE McClellan oscillator and summation index continue to be negative, and we're still negative with the Swenlin trading oscillator, the bullish percent index, the parabolic SAR, ease of movement, the money flow, the vortex, all of our oscillators, the ultimate oscillator, the Copic curve, and the bullish percent index for the NYSE. And when we look at the NASDAQ 100, the PPO, the momentum oscillator that we use, is still extreme, but trying to turn up. The bullish percent index improving, but still negative. And then on the positive side, we have the S&P McClellan oscillator as well as the summation index. They have the McClellan oscillator crossed back above zero, so that's turning the summation index back up based on price. Not really turning up yet based on volume. And our advanced decline lines continue to hold up fairly well. The financial sector is also doing fairly well right now. So our conclusion, and this is pretty much across the board here, we're still negative. Excuse me, but we are showing an improvement, and that's what we're seeing in the short and intermediate term, where we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a very good weekend, and I'll be putting out the weekly videos, so I hope you'll find some use in those as well. So have a great day, and I will talk to you in the next video.